last week, we might go into that Nike discussion a little bit, but last week we did discuss the MU position related to that double diagonal earnings. This was a sample trade. We put in the numbers that existed Friday after the close for the MU position. The stock was trading, I believe, at around $81, maybe $80.50 on Friday's discussion. And at the time, we could have sold the April 75 put and sold the out-of-the-money April 82 call with a high implied volatility, 209 and 191. Going further out in time to May, buying the deeper out-of-the-money put for the double diagonal cost us 281 for the 70 put, about 60 days out in time. 56 days out in time, I should say. And the May 85 out-of-the-money call was $1.91. It was essentially a wash there with the midpoints on that spread, the 82 April 1st and the May 85 call. And we saw this profit and loss chart. Now, the earnings did jump up to 85 right after the earnings, but it was a down day. I think it was Tuesday when the earnings came out. The market was in a down day, I believe, but MU originally jumped up, and then in the last few days, it sort of gradually moved back down. It was a positive earnings, and it was a positive outlook as well, but it did pull back down to 76. So what's going to happen here is both of those options, our sold options for April 1st, would have expired worthless, and we still have some reasonable value as we saw back in the portfolio. The May 70 put at 281 on Friday is still worth 242 right now. We only lost about 10 cents on that May 85 call. It's down to 182, so we could liquidate this position right now. Original debit was $72, make a profit of about $351. So this was a potentially successful double diagonal around earnings. And oddly enough, although the implied volatilities naturally collapsed here on our short options, you see you had the run up right towards earnings, and then it sort of came right back down very quickly the last couple of days. That's what we wanted to have happen, and that's what would work. That's how this double diagonal works, is we're trying to play the implied volatility as it spikes up going to earnings, and then you get the collapse. But unfortunately, what happened with the Nike position that Ron had mentioned, when I looked at the cross earnings from, I think it was March 21st, earnings came out at the end of day, to March 22nd, the long options collapsed hard in implied volatility as well. I'm not sure if he was 1 week out, 2 weeks out, or out to May. But again, taking a look at that here, I'm going to go to call research. We did see some implied volatility collapse around the earnings for our long options, but it only dropped from about 0.5 to around 0.4. It was a drop. That drop in implied volatility will affect the expected prices of the options when you're analyzing a profit and loss chart. That's what we talked about last week. We want to account for that change. If it goes to its lower range, can we still make a reasonable profit on the position? So this one would have seen a decline in implied volatility, just not as steep as the near-term expirations of April 1st, April 8th, and April 14th. And that's the same thing that happened with the Nike position. The near-term options, yes, the ones that collapsed that he would have sold, likely the March 25th series for Ron, the long ones collapsed a little bit more. Let's take a look at that right now. I just want to go run through it real quick, what we have so far. So let me go on ahead here and open this back up. So we're just going to run through this. This is sort of a review in a sense from last week, but it's looking more in depth. So let's go ahead and get into it. So Ron had mentioned last week, of course, that he was in a double diagonal that lost money. And it was for Nike, of course. It was a double diagonal for an earnings play. We don't know the setup here. I don't have a trade set up in here, but we're going to just take a look at the numbers here so you can experience why we called it the risks of a double diagonal as an earnings play. So that was from the previous webinar that we just posted, and I just went sort of through that. He had a position on Nike, and he said that all 4 options lost implied volatility, and his long options that were further out were not the value he expected due to that implied volatility decay. And we just talked about the MU position. But let's take a look back. On March 15th, Nike was trading at 119. And the earnings were coming out on the 21st, as I mentioned. And we can see here that at the time on March 15th, our implied volatilities were pretty high, 0.72, 0.73. This is for the March 25th expiration, the closest to the earnings date. And the percent implied volatility ranges are all 94, 95% here for the calls, 85, 94, 91%, but still in the same range, 0.72, 0.70, 0.705 for the put options. So naturally, we expect to see this sort of increase going into earnings. And what we want to do is sell these near-term ones and buy some further out ones that we hope aren't going to be as affected by the earnings date. Now, going further out in time, on the same day, March 15th, we still see on the other expirations, the further out expirations, we do see similar increased implied volatilities due to the known event coming up on the 21st. But going farther out in time, they're not as high. April 1st, today's expiration. Well, the implied volatilities are a little bit lower, 0.61, 0.6178, 0.6125, but we're still at the high of the implied volatility range for those particular options. We're just kind of looking at the money options right now for these different expirations. So we saw what March 25th was, and here we see April 1st expiration. Now, this is kind of weird. These are pretty low, 18%, 23%. They're around 0.58 and 0.5741. Kind of close to the calls, but not as high. Standard April expiration, same day, March 15th, we're only at 65, 61, 68% implied volatility, but the puts are 88%, 89%, but we're about even. As far as raw volatility goes here, for the standard April expiration, 0.49, 0.515, 0.53 versus 0.52, 0.50, 0.48. So they're very similar. And then going 60 days out, that May expiration, May 20th, standard expiration, more normalized implied volatilities, 0.41, 0.42, 0.44, and the percent IV range is right around 55, 56, 60% or so. Puts a little bit higher here, but they're still within the same implied volatility ranges, 0.41, 0.43, 0.40, even a couple 0.39s in there as well. Their IV range is around 78%, 73% for that particular options, the at the monies. Now, let's take a look at what happened. This is the chain from March 21st and March 22nd for the expiration of March 25th, the date closest to the earnings event. So on March 21st, now we're near very, very high implied volatility ranges. We're at 0.90, 0.911, 0.9099 on the calls, 0.92, 0.93, 0.9370 for the put, 70 to 80% range. And what happened following day after the market closed, and of course we are higher, I must mention that here, we went up to 130 the day before earnings from 119 on the 15th. Here we are at 133 on the 22nd, the day after the earnings was announced, the full trading day. This is the close prices. And where are we at? Exactly where we'd expect to be. This is what we wanted to have happen. We would have sold those options in the higher implied volatility, and they collapsed from the 0.93 and the 0.90 down to 0.35, 0.34. That's going to help us. It's going to be cheaper to buy these options back simply because we had the implied volatility crush in our favor. But now the question comes, what theories was bought against these ones that were sold? If we just went to the next week out, the April 1st expiration, these did see an applied volatility crush as well. Not as high, but it would have been vastly affected. The day before earnings, the day of earnings, I should say, earnings came out after market, we're at 0.60, 0.59. Puts are about the same, 0.61, 0.60. 70, 55% implied volatility range. On the 22nd, where do we go? Back to that low level where the implied volatility were. They went to a new low. See here, this is at 0.348, but the lows here were 0.525. Now we're at 0.30, 0.314, 0.3125. Same with the puts, 0.30, 0.3081, 0.2972, all setting new lows in implied volatility. Why is this important? Well, if what Ron had done was sold the 325 series and he got the applied volatility crush in his favor, if he just combined the double diagonal with the April 1st series that we're looking at here, he would have seen a drastic reduction in expected price of these options because the implied volatility crushed down about 50%. So this was a pretty big move, and that's why the position might have seen the effect it had for Ron, unfortunately, if he was too close with the bought options on the expiration. But all expirations were affected. We go out to April 14th, the standard expiration. We saw that we day before earnings were at 0.45, 0.46, 0.44 in this range here, and 0.467, 0.46, pretty good. On the 22nd, full day of trading after the earnings, the implied volatilities of that April 14th series drops down to 0.29. And for the puts, about the same, 0.28, 0.2842 in that range. So we still see a pretty significant decrease in implied volatility, even going 30 days out in time when the position was open with still 23 days left. Still saw a reasonable implied volatility crush. Further out, let's go to May. Instead of looking at all weekly expirations, let's just go to the standard May series here. And once again, going into the earnings, this is pretty low, 0.37, 0.364, 0.355, 0.3492 on the put side. Earnings passes, next full trading day, it does drop, but we only go down about 0.30, 0.289. Our puts are at 0.29, 0.27, 0.269. So there's still a volatility crush, but it's a little bit lower. Not as extreme because we were further out in time and those options weren't as affected. They wouldn't have costed much because they didn't have that higher implied volatility rate we saw in the other series, and it didn't experience much of a collapse. Better to look at that at a table, of course, so we can see the exact numbers. And what did we essentially do? The average of those at-the-money options for the expiration of March 25th, the average implied volatility on March 21st, calls and puts, was 0.9196. Day after the earnings, the average of the at-the-money options was 0.3532, 61.6, let's just call it a 62% decrease in implied volatility. That's the one we would have sold. That's the one that would have worked in our favor. April 1st, expiration series, another week out in time, today's expiration. The average implied volatility on March 21st, the day of earnings, was 0.6041. And the average implied volatility the day after earnings was 0.3085. So it was about a 49% decrease in implied volatility. That would have affected the expected outcomes if we had bought the April 1st series and sold the May 25th against it. The remaining value that we would have analyzed on a profit and loss chart if we didn't consider the implied volatility collapse would have had an inflated price. And where we thought we might have had a profit, it would have actually ended up as a loss because the implied volatility collapsed. Standard April 14th expiration, 0.4571 for the March 21st end of day for all, again, at the money, calls and puts, a couple strikes in, a couple strikes out. March 22nd, the average IV after the earnings was 0.2885, lost about 37% in implied volatility change. And then the further out series, about 60 days, going into the earnings, the day of earnings, average implied volatility was 0.3629, and the average implied volatility the day after was 0.2918. Still a 20% decrease in implied volatility in those cases, but it's much less than those nearer terms. So we see a huge decrease here, but that's the one that worked in our favor. But these two here are still a massive change in implied volatility. And this is still a pretty big change in IV as well, don't get me wrong, but it's much less. And so my concern was with the other position, Ron had mentioned that he lost on the double diagonal. I fear that he might have been trading one of these closer in ones that suffered the more massive implied volatility collapse as his bought options. And that's why his position was not successful with a double diagonal around earnings. I do think that this is a good target, 50 to 60 days out in time. If you decide to play this strategy, a double diagonal around earnings, I'm not recommending it. It does take a lot, and you've got to analyze a lot. And you've got to run what if scenarios with change in implied volatility to make sure you have a reasonable position that would still profit if the IVs go back to where they were. In Nike's case, the implied volatility of the remaining options went lower. They were all around 0 or 1% of their implied volatility range the day after. They were creating new lows in implied volatility. But I think that buying 50, 60 days out in time on positions that are usually not as affected as earnings as the closer term. Are they going to be more expensive to buy? Yes, you're paying into more time value. But again, I don't think you're seeing as big of an implied volatility crush in those cases. So it's easier to manage those positions, where if you're just selling 1 week out and buying 2 weeks out, you're going to see that kind of collapse. If you buy selling 1 week out, or closest to the earnings date, and just buying 2 weeks out after that or 3 weeks out after that, you're still going to see a reasonable decline in implied volatility. One example does not the market make. Not every stock is going to react this way. Just a few minutes ago, we talked about the MU position, how the implied volatilities fell, but they didn't fall by that much. For the longer term, we were still looking at that May 20th series that was 50 to 60 days out from last Friday's example, and that was the successful trade. But I think if we would have done the MU position with the April 1st sold and the April 8th bought, we might be seeing this kind of implied volatility decay on our April 8th long options, or even the 14th in that case, seeing maybe a 35, 36% decline in implied volatility, which would have changed our expectations and changed our expected values, where we thought we should have had a profit if the stock didn't move or stayed where it was. However, we see a loss on the position because of the implied volatility collapse. That's just reinstating the risks of the implied volatility and the importance of understanding the implied volatility if you're playing any strategy as an earnings strategy, where you have to really evaluate the worst case scenario. If the implied volatility of your options goes back to the low range or goes even lower, you want to run that in the profit and loss chart on PowerOptions to make sure your position would still be profitable. So that's basically what that one was. And I have some others, excuse me, I have some other images I'm going to put on the slides to review the MU position and the implied volatility collapse on that one as well. So we'll maybe take a look at that. It's not done yet, so you might see that as a future presentation in a little bit going forward, I should say. Okay, so I just wanted to review that, of course, for the implied volatility and the implied volatility collapse there, why it's important to analyze the positions that way. Let's go back to PowerOptions real quick. And like I said, even though we saw last week the mention of a position that was not successful with that type of play because the implied volatility crush, which we just reviewed, the MU position that was just a sample trade. It wasn't a real trade. It's just something we put together Friday during the webinar to take a look. But what I mean by analyzing this, let's see if we can go to the profit and loss chart. There we go. So the stock is here, and we see an expected profit EF 352. These implied volatilities stayed up at 0.46. That's where they are right now. They didn't see much of an implied volatility collapse, and this was a profitable position. But if this did have a collapse, what I would want to do is say, well, if the low value was around 0.25, let's say if it goes near to 0.26, it goes near the low for my remaining long options after the earnings event, which happened this week for MU. And I said, okay, well, if the implied volatility goes back to its lowest range, I think the lowest range was 0.4, by the way, but let's say it was 0.25. What I want to do is analyze what this would look like now if the implied volatilities had crushed on my long options, dropped down to their lower range, whatever it is, put that into the field and calculate it. Now you see the expectation is only making $46. Still a profit, but I have to account for that implied volatility collapse. I don't need to change these right now because they're both out of the money, so they're just going to zero as it is because today's the expiration day. But you want to make sure that you see what the implied volatility range is, either on the portfolio or in the option research view. Let's just take a look here. Okay, so there's the total implied volatility, but I'm going to scroll down here. Yeah, the implied volatility range, the lowest was 0.388 for this particular option. The put might be the same. So go back to the profit and loss chart, of course, there, put that value in 0.388. And so, yeah, we have the $300, $350 profit on the position right now. Because the volatility stayed up around 0.4, keep adding an extra decimal point. All right. But again, with those numbers there, we only expect a profit of 2488, not the 352 that we're seeing with the volatility of 0.4. So it's important anytime you're doing any type of time spread, diagonal spread or double diagonal, especially if you're trying to play an event such as earnings, you want to make sure that you evaluate what your potential profit would be if volatilities collapse, volatilities change, so that you can see that going forward and you aren't surprised when suddenly, hey, I bought a 20-day out option and I sold a 7-day out option. Earnings came out the day before my near-term expiration, I should have a profit of $250 and all of a sudden I'm losing money. How? You want to make sure that you know that ahead of time using the tools here in the what if scenarios and the calculate expected profit and loss by adjusting your volatility to the lower range for analysis. All right, fantastic. Okay, so that's just that review there. A little follow-up to our discussion, and I wanted to take a look at more of those prices that we saw there for Ron as well to see what had happened with those near-term options as we got closer to expiration. Excuse me, right after the earnings event. I apologize, right after the earnings event.